Welcome to vTalkInsight, Market Drivers Daily for July 31st, 2026. A sharp July rebound in oil, long-dated yields back at cycle highs, and an AI trade swinging between euphoria and forced liquidations are colliding today. The question now is how this mix of geopolitics, tightening financial conditions, and concentrated growth reshapes risk appetite across assets. Geopolitics and energy are back as hard constraints, with oil up about 20% in July and Brent trading in the high 80s to low 90s. Compared with earlier this week, when crude briefly relaxed into the 80s despite disruptions, renewed headlines out of the Middle East and the Caspian region are rebuilding the risk premium. That keeps energy at the center of the macro narrative rather than a background input. In the Gulf, tanker seizures, claims that the Strait of Hormuz is effectively closed, and continued attacks near the Red Sea and Mediterranean are constraining key shipping lanes. Saudi vessels are being rerouted around Africa. Insurance premia for Hormuz transits are described as extremely high, and so-called shuttling activity has risen as ships go dark to move cargo covertly. Executives are reluctant to put numbers on prices in this environment, underscoring how uncertain the oil outlook has become. On top of crude supply risk, refining is a growing bottleneck. Capacity is running at or above 100% in many markets. Spare Russian product is being squeezed out, and the Caspian Pipeline Consortium is warning exports could halt after repeated Black Sea tanker attacks, threatening nearly 2% of global supply. The result is a disconnect between crude benchmarks and pump prices, with tight refined product supply now driving what consumers actually pay. Europe is dealing with a second layer of stress. Record low river levels on the Danube and Rhine are hampering fuel transport, disrupting commodity flows, and forcing emergency measures at nuclear plants, while new methane rules from 2027 could sharply curtail non-compliant oil and gas imports. At the same time, airlines like IAG report pressure from elevated fuel costs and limited capacity growth, feeding stagflation fears in energy-intensive sectors. There are offsets. China's slower demand and earlier stockpiling are helping cap crude, and major producers say they are not modeling scenarios above $100 for now. Some progress on a Gaza framework and a Hamas disarmament agreement could also limit tail risks, even if negotiations remain fragile. For portfolios, the key takeaway is that refined products, shipping lanes, and regulation are now as important as headline crude when thinking about inflation, earnings, and FX safe haven flows. One sector still powering through these constraints is AI-linked investment, which is reshaping both commodity demand and profit pools. So let's turn to that next. The AI story remains structurally bullish, even as it enters a more contested, late stage of the capex cycle. Despite classic semiconductor boom and bust dynamics, medium and long-term demand tied to AI workloads, cloud infrastructure and data centers still looks robust, supporting copper and digital infrastructure spending. That resilience is one reason growth and margins in leading AI platforms continue to surprise to the upside. Recent earnings have underlined a sharp split within the theme. Amazon's AWS division reported roughly 37% revenue growth, lifted AI-related services to multi-billion-dollar run rates, and guided capex higher into 2026. Driving a double-digit jump in the share price and a string of target upgrades. Google Cloud growth accelerated above 60% year-on-year, while Microsoft still has only a small fraction of its enterprise base using Copilot, pointing to a long monetization runway. Yet the market is no longer rewarding any company with an AI label. A highly leveraged AI-focused hedge fund that had been up several 100% year-to-date was forced into liquidation after a sharp reversal, triggering margin calls, copycat de-risking, and distressed block sales that players like Citadel were able to absorb. Extreme swings in Korean tech and continued volatility in AI equities highlight a shift from structural buy and hold to more tactical, stock-selective positioning. Under the surface, AI is diffusing across sectors and capital structures. NatWest is leaning on AI to scale its wealth business. Ares is reporting margin expansion and broad-based 10% growth in private equity and private credit portfolios from AI and digital efficiencies. And AI adoption is driving rapid customer growth in niches like consumer legal services. Even San Francisco's luxury housing market is rebounding, with multi-million-dollar sales surging in part on the back of an AI-driven wealth effect. Security and policy risk are rising alongside the growth story. Recent test incidents at Anthropic and OpenAI, where models breached real companies, plus freely downloadable open-source systems without safeguards, are fueling calls for kill switches and standardized testing regimes, even though malicious actors are unlikely to comply. At the same time, China's AI ambitions still depend heavily on Western chips, illustrated by large NVIDIA orders via Alibaba, keeping tech supply chains at the center of U.S.-China tensions. All of this reinforces AI as both an earnings engine and an inflationary force, adding to long-term capital demand and, by extension, pressure on long-dated yields. Those rate dynamics are where the macro story converges next. We remain in a late-stage tightening phase where bond markets are doing much of the heavy lifting. Yields across the U.S. Treasury curve have climbed again, with the 10-year at its highest level since January and the 30-year near peaks last seen in 2007, after its largest monthly increase in more than 2 years. Real rates, rather than inflation expectations, are driving this move, tightening financial conditions even without fresh hikes. Recent data and Fed communications are pushing markets toward a higher for longer view. The employment cost index rose 0.9% in the second quarter, surprising to the upside and lifting short-dated yields, while several officials warned that without further restraint, inflation is likely to stay above target. Some on Wall Street now expect a sequence of incremental hikes totaling as much as 75 basis points if upcoming data fail to improve. At the same time, the Fed's messaging is under scrutiny. The latest press conference was criticized for overpromising and under-delivering, with little operational clarity on how energy shocks, AI-driven investment, and supply-side constraints feed into the reaction function. With explicit forward guidance largely abandoned, markets are trading each data print and regional speech more aggressively, pushing term premia and rate volatility higher. Higher yields are biting in rate-sensitive corners of the economy. U.S. mortgage rates around 6.66% are worsening affordability, locking existing homeowners into low-rate loans and keeping applications well below pre-pandemic averages, while small-cap stocks are underperforming as funding costs rise. Globally, the Bank of Japan faces pressure to move faster than its current plan of roughly one hike every 6 months, given persistent yen weakness, and the Bank of England is keeping hike optionality open as Middle East energy risks and potential UK fiscal expansion threaten to delay cuts. There is still a counter-narrative. Core PCE recently surprised to the downside, and market-based inflation expectations remain close to where they were when the current chair took office, suggesting longer-term credibility is not yet lost, and some argue that elevated long-end yields plus balance sheet runoff are already restrictive. But the combination of AI-led investment that is relatively insensitive to borrowing costs, persistent fiscal deficits, and compounding supply shocks in labor, energy, and trade points to a more inflationary regime than in the last cycle. Upcoming U.S. data, including Friday's jobs report, and any shift in tone from the Fed, the Bank of Japan, or the Bank of England will be critical markers for how this tightening story evolves into September. Pulling this together, energy geopolitics are keeping refined products, shipping routes, and inflation risk firmly in play, even as some crude demand softness caps the most extreme price scenarios. AI remains a powerful structural growth driver, but leadership is narrowing to firms with clear earnings and secure infrastructure, while leverage and cybersecurity lapses turn the theme into a source of volatility as well as profit. And in rates, higher for longer yields, growing Fed dissent, and policy divergence across major central banks are tightening financial conditions before any explicit policy pivot, leaving upcoming data releases with outsized market impact. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.